We will now be looking at some other general intragroup transactions, and the first one is intragroup rent. If one of the entities in the group, and that can be P or S, rents an item from the other entity in the group, P or S, and rentals flow between the entities, these rentals will be intragroup and will therefore need to be eliminated for consolidation process. That is intragroup transactions. It is not then income and expenses with parties outside of the group and will therefore not be allowed in your consolidated numbers. Although different scenarios may arise depending on the classification and treatment of the lease by the lessee and lessor, the only scenario within the scope of your consolidations textbook and these videos is where the rental agreement between the parties in the group is a lease in terms of IFRS 16 leases, which we will be doing later this year, and the lessor has classified the agreement as an operating lease, and the lessee has elected to apply the recognition exemption in respect of the qualifying asset. Now that is a mouthful, and you will understand it better once we've done IFRS 16. All you need to know at this point is that one entity, the lessor, would have recognized rental income in its separate financial statements, and the other entity, the lessee, would have recognized a rental or lease expense. So the consolidation journal entry to eliminate the effect of this intragroup transaction would be as follows. The rental income will have to be debited. This will achieve other income to be reduced so that you're left with rental income only from third parties to the group, and your rent expense or lease expense will have to be credited so that that is eliminated out of other expenses in the consolidated splockie. The purpose behind this consolidation journal entry is to ensure that the line items other income and other expenses in the consolidated statement of profit and loss represents income and expenses with parties outside of the group. Let's assume the rental expense was for an amount of 5,000 Rand. Then the debit would have been for 5,000 and the credit would have been for 5,000. You would agree that this consolidation journal entry will not have an effect on the total profit of the group. If you increase and decrease profit and loss for the same amount, it does not change the profit. But again, the purpose behind this consolidation journal entry is to get the line items in the consolidated statement of profit and loss to be a faithful representation of transactions with parties outside the group. Intragroup loans. If one entity in a group, and that can be P or S, grants a loan to the other entity in the group P or S, and interest is levied on the outstanding loan amount, the loan balances as well as the corresponding finance cost and finance income will be intragroup and will need to be eliminated for consolidation purposes. If you have an intragroup loan with intragroup interest, it means that one entity in the group recognized finance income and the other entity recognized finance costs. When you prepare the consolidated statement of profit and loss, line by line, you will start by adding 100% of the parent and 100% of the subsidiary from their separate financial statements. This will then happen on the finance income and finance cost line items. To eliminate the effect of the intragroup transaction, you will have to write this first consolidation journal entry. The finance income line item will have to be debited. The effect of that is that the intragroup finance income will be eliminated from the combined totals so that you are left with finance income from parties outside the group. The same will have to happen with finance costs. the finance cost combined line item will have to be credited with the finance cost intergroup amount so that you are left with finance cost relating to transactions with parties outside the group. If this was for an amount of, let's say, 2,000 Rand, the debit and the credit will be for 2,000 Rand. Again, because this is a debit and credit to profit and loss items, this first consolidation journal entry will not have an effect on the total group profit. The purpose behind this first consolidation journal entry is to ensure that your finance income and finance cost line items in the consolidated splotchy represents transactions only with parties outside the group. This gives effect to the single economic entity principle. So even though this first consolidation journal entry does not change the profit of the group, it's still necessary to write this to ensure fair representation of your line items in the consolidated splotchy. For as long as the intragroup loan is still unpaid or still has an outstanding balance, the second consolidation journal entry will also be necessary to eliminate the loans due liability and the loans granted asset. To achieve that, loans due will be debited and loans granted will be credited. This will ensure that your liabilities with regards to loans in the consolidated SFP only represent loans due to parties outside the group. Same for loans granted. By eliminating the loans granted out of the assets section of the consolidated SFP, you will be left only with loans granted to parties outside the group. This consolidation journal entry only affects SFP balances, and therefore it will not have an effect on the consolidated profit or loss of the group. Another general intragroup transaction that you'll often come across is intragroup management fees. This is where one entity in the group renders administrative or management services to the other entity in the group, and as a result, one entity will recognize management fee income and the other entity will recognize management fees as an expense, both through profit and loss. Again, to eliminate the effect of this intragroup transaction, you need a consolidation journal entry. The management fees received or income recognized will be debited. This will then usually be against the combined line item other income, and the combined line item other expenses will include the transaction for management fee expense recognized by one of the entities. By eliminating this income and expense in the separate line items in the consolidated statement of profit and loss, you again achieve that your other expenses and other income line items represents only transactions with parties outside the group. If we had management fees of 8,000 Rand applicable to this scenario, the debit and the credit would be for 8,000 Rand. And this is just to illustrate that this consolidation journal entry will again not have an effect on the total profit of the group, because both entries affect your profit and loss for the same amount.